Just going to touch on discretionary retail today, if we may. So this is a subset of consumer discretionary, and these are companies that actually sell stuff from stores. So there's 8 companies within the universe. They range between apparel and homewares, electronics, automotive, leisure. The largest being JB Hi-Fi, of course, with a market cap of about 5 billion, and there are 4 stocks with a market cap of below half a billion. What I want to touch on is what we're seeing in retail sales. There's an awful lot of negativity and, shall I say, hysteria around discretionary retailers in the stock market at the moment, and yet it's just not coming through in the data. This is the retail sales data reset as real movements. So effectively what we're doing is we're netting off inflation, CPI, with retail sales. So you can see what's actually happening if you take out the effect of inflation. And we are in the red, but we're only just in the red. And in fact, last month, we actually improved slightly on where we were the month before. So to give you some numbers, what we saw in the last month that was reported was 4.2% growth on an annual basis year on year. And when you adjust that by inflation, it's down 1.5%. Now, that is not the cliff edge that people are expecting or the cliff edge that's implied by the share prices. So obviously people are expecting things to get worse. And we're no exception to that. This is what we're expecting to see in terms of like-for-like sales. So you can see on a median level, we had 2% like-for-like sales forecast for these stocks in FY23. That declines down to -3. So bear in mind that includes the effect of inflation. So we're effectively saying that things are going to get substantially worse from a like-for-like sales perspective in the year to come. And our numbers are not dissimilar from the market. If you look at individual components of this, you can see that we've got very significant falls in some of the companies. Most are negative. In fact, only one is positive, being Lovisa. And only one is going up, which is Baby Bunting. And of course, Baby Bunting is coming off a very difficult year in FY23. So that's more of a normalization. Actually, if you look at Baby Bunting in FY24 compared to FY22, it's down 45% in terms of EPS. So we do have the expectations that things are going to be pretty tough in FY24. And that is very much the consensus view. Or at least it's become the consensus view, because this is what's happened to EPS expectations, is consensus EPS expectations over just the past 6 weeks for these stocks. So on average, or on a median basis, we've got 14% decline in EPS just over the past 6 weeks. But you can see here there are massive variations. Stocks that have had profit warnings, which are denoted by my rather striking flashbangs there. Those stocks are the ones where people have taken numbers down. Why? Because we've been told what numbers to expect. So that's what we've got in terms of EPS movements for next year. And you can see that's a mixed bag. Now, most stocks, we assume that EPS is going to fall next year, but that's not the case for everyone. I draw your attention here to JB Hi-Fi and also Super Retail. So a couple of the biggest stocks in this sector where we've got very substantial falls in EPS next year, which I think are actually eminently beatable. For a lot of these companies, particularly for Super Retail, which I think is showing really significant signs of underlying resilience. The only one that really stands out, of course, is everybody's favorite purveyor of cheap jewelry, which is Lovisa. And Lovisa, we do expect to see EPS growth continuing, so 31% into next year. Now, of course, this is all driven by the rollout. Lovisa is a global business, so we're not dealing necessarily with Australia in isolation, but 25% growth in the estate is what we're forecasting for FY24. That's a significant driver of growth when it comes down to EPS, as you get leverage on that and through the supply chain. So that's why that one's an outlier. But the others, as you can see, we're expecting negative sales momentum, earnings momentum for all of these companies. A reasonable question, I think, is whether we're all too positive on operating margins. Operating margins, generally speaking, for retailers had a very positive experience during the pandemic. That was largely because gross margins were pushed up. They didn't have to discount. Nobody had to discount because we didn't have enough stock to sell. So when we look at the margins, certainly we saw some declines in sales, but operating margins were certainly supported by that gross margin boost from not going down the path of discounting and promotion, which of course we are going down now. So I think there is a temptation across the street to say, well, the margins that were achieved in COVID, maybe that's a new normal. Maybe that's what we're going to see going forward. And that's not the case in terms of our expectations anyway. If I were to apply the operating margins on a pre-pandemic basis to all of the stocks that we cover in FY24, you can see most of the companies I'll be upgrading because I'm forecasting a lower margin than they achieved even pre-pandemic, and certainly a significantly lower margin than they achieved during the pandemic. So there's no gung-ho optimism in the margin expectations here. So all of this is okay, except the share prices aren't. Everything has got significantly cheaper. This is the 1-year forward PE. And just to put some numbers around this, the median for this group of companies 5 years ago was 12.1 times. At the peak, which was in January 2022, the median for this group of stocks was 23.5, and now we're at 10.2. So all of the re-rating that we saw this segment go through during the pandemic has been lost, and then some. So this is a significantly cheaper group of stocks, and they are reflective of the sector than we have seen over the past 5 or so years. And yet things could change. This is a chart I've shown you before, which is the relationship between consumer sentiment and consumer share prices as defined by the ASX 200 Consumer Discretionary Index. Now, this is not perfectly correlated, and I've had long and stimulating conversations with Michael Knox as to why it's not correlated, but it is, I think, related. There does appear to be, in general, a relationship between poor consumer confidence and poor trading in the share market of these stocks and vice versa. Now, that makes sense to me because if you look at how consumer sentiment indices are put together, what's happening is people from Westpac are going to consumers and saying, how do you feel about the future? Not what you're doing now. How do you feel about your future spending intentions? And of course, that's the way that we're thinking as investors. We're trying to think, what happens next to this group of stocks? At the moment, as you can see from the blue line, which is consumer sentiment index, we're at pretty much the lowest point for consumer confidence in 23 years. This goes back to 2000. And you'll see that this has really been in the doldrums for really the last 6 months or so, of very significantly low consumer confidence. And of course, we've seen a correction accompanying that in share prices. Of course, the natural conclusion from this is that when things start to turn up in terms of consumer sentiment, you ought to see an improvement in the share prices of these companies as well. Now, what could drive that, of course, is a moderation of inflation, accompanied by the RBA staying on hold. Because all of this has happened, of course, in the context of 12 rate rises and CPI, which has averaged 7% over the past 12 months. If we get to a point at which we can see light at the end of the tunnel, maybe that consumer, when they're asked how they feel about the future by Mr. Westpac, are going to say, you know what, I think things are getting better. And when that happens, I would expect share prices to respond positively too. And just finally, if, as I say here, you're not convinced, maybe today's not the day to do it, given that the Consumer Discretionary Index in the US got belted overnight. But these are the share prices of a selection of well-known discretionary retailers overseas in recent months. And you can see that investors in the US and Europe seem to be taking a rather different approach to us in Australia. Maybe we're right and they're wrong. But just wanted to put some context around it. Inditex, which I mentioned just now, which owns Zara and Massimo Dutti, share price up 68% since October. It's just gone vertical. That's the orange line at the top there. But all of these stocks that I pulled out have experienced really strong share price improvement over the last few months. And this is not because they've been beaten up coming into this. None of these stocks were particularly an underperformer in FY21 and FY22. And yet the attitude of investors in the US and Europe seems to be these stocks are going to do well in the future because they have a good brand, they have a good strategy, and most importantly, the consumer is proving resilient and there is light at the end of the tunnel when it comes to elevated inflation, which in parts of Europe, of course, is now in negative territory. So this is in our future, I hope, and I think you'll see the share prices in Australia reflect that.